Hello, welcome to Accounting Hub. I am Professor George Scarping, PhD in Accounting, and our topic today is about cost and volume profit analysis or CVP analysis. And when we talk about CVP analysis, we are talking about break-even point. What is the break-even point? Break-even point is the sales level at which operating income is zero. So total revenues equal total expenses. If our sales are below the break-even point, we have a loss. If our sales are, if our sales are above break-even point, we have a profit. And we have three ways to, to calculate it. The income statement approach, very rare. The shortcut approach using unit contribution margin, and the shortcut approach using contribution margin ratio. Let's go here. The income statement approach. We have sales revenue less variable expenses less fixed expenses equal operating income. If we work with what is sales revenue? Sales price per unit times unit sold. What is variable expenses or variable cost? Variable cost per unit times unit sold. Less fixed expense equal operating income. And then we have operating income here, zero. We can find, if we have our sales price, our variable cost, and fixed expenses, we are able to find our unit sold. Or we can go further. And then we can use the contribution margin approach. That is the most used one. Sales revenue less variable expenses. It is contribution margin. Less fixed expenses equal operating income. What is contribution margin? Contribution margin per unit times units sold. That is what we want to find. And then if we do our formula, we have sales in units equal fixed expenses plus operating income divided by contribution margin per unit. What if we want to know not the sales in units, but the sales in dollars? We use the contribution margin ratio. So sales in dollar, fixed expenses plus operating income divided by contribution margin. And then we have the graphics. We can graph it. Step one, choose a sales volume. Plot the total for sales revenue at that volume. Draw the sales revenue line. And then the fixed expense, total expense, and we identify the break-even point. Let's do here in our Excel file. Remember, all of our Excel files, they are available for free. The link to download it is in our video description. So let's do it. Let's consider selling price 65, variable cost 35, or variable expense 35, fixed cost or fixed expense 72. And then we have a lot of volumes here. So let's create a series for revenue. Revenue when we sell 0 units. It is units times selling price. And let's fix this selling price here. Let's copy and paste. And we have our sales line starting at origin because when we sell nothing, we have nothing, no revenue. And then it goes up. Now let's consider our total cost. Let's consider that we have only fixed cost. Let's disconsider the variable cost for now. 72, open paste, will be always, will be always 72. So here we will be in horizontal line. We don't start it at origin because it is fixed cost. But let's consider the total cost. So it is the fixed cost plus variable plus volume times variable cost per unit. And now we will fix the variable costs and we will fix the fixed costs. The same 72 because we don't have variable cost for now. Open paste here. And here we have our graph. Where when the two lines overlap here, we have the break-even point. Anything to my left here on this area, this is my loss area because my total cost is greater than my revenue. Anything to my right, here we have the profit area because our sales revenue is greater than our total cost. However, how much is this one? Let's just do it right here. Horizontal, they are here. Okay, perfect. It is something around 2500, maybe. How do we find it? We have our formulas the same as our PowerPoint. Break-even point, fixed costs, plus operating income. Here we are working with a break-even point, so we have no operating income, divided by unit contribution margin, 65 less 35. And then we have the 2400 units. As I told you, around 2500 units here. How do we find it in dollars? First of all, we find the contribution margin ratio. That is the contribution margin, selling price less variable costs, divided by selling price. 46.15%, our break-even point will be the fixed cost divided by contribution margin ratio, 156. How do we double check if it's right or wrong? Break-even point in units times the selling price. We will have the same $156,000. However, we have a problem here. Uh, Usually, I don't want a company that I will not only lose money, I want profit. What happens if we want a profit? So the same time series here. However, here we have the cost plus income. So we will add this operating income. For instance, $30,000. Wow, then we need to sell more. Let me fix these X's here. Okay, better. Oh, it's more than 30,000, almost 3,500. Let's do it. Fixed income, fixed cost, sorry, plus operating income divided by unit contribution margin. 65 less 35. It is, whoops, it is not, sorry. It's not money here, it is units. 3,400, almost 3,500. To find it in dollars, contribution margin ratio, selling price less variable cost, divided by selling price, the same 46 because we are working with the same numbers, and then break-even point for when we want operating income, fixed cost plus operating income divided by contribution margin ratio. So $221,000. Lastly, what we have? Sensitivity analysis. Prepare for increasing costs, pricing pressures, and other changing business conditions. And we use the what if technique. What if sales price changes? What if cost change? What is the sale mix changes? We will not be working with this one because we have only one product. But what if sales or costs change? Let's do our sensitivity analysis here. Let's work with this one with no income. What if our selling price is not 65 anymore, it is 50? Remember, our break-even point is 2,400 units. It is around here. I will leave my mouse here. Let's check what will happen. Whoa, it goes up. We need to sell much more. 4,800, the double. only because our selling price decreases in 15. Let's go back. And now let's decrease it in 15. For instance, let's increase it in 15. So 80. Whoa, now our break-even point decreases. We need to sell only 1600 and not 2400 anymore. What if our variable cost changes? Instead of 35, it is 42. What happened with our break-even point and with our total cost line? Starting at the same point here, however, the break-even point goes up. When our variable cost goes up, we need to sell more. So our break-even point also goes up. What if variable cost goes down? Instead of 35, 30. My break-even point goes down because we need to sell less. However, our origin remains the same. Finally, what if our fixed cost changes? Instead of 72, 92. Our total cost changes, but that's quite funny because our slope remains the same. What changes is our origin. Instead of 72 here, we have our 92 there. So make it better. Instead of our 72 here, we have our 92 there. So it goes up. And then our break-even point also goes up. What if decreases 50,000? Let's mark it here. Here, our origin. Now it goes down, but keeping the same slope. So our break-even point goes down. Just pay attention here. If we have this Excel file here, it's quite easy to perform any sensitivity analysis. It's quite easy. We only need to change our numbers and our graph changes automatically. So much easier if we have the right tool. And then remember, this Excel file is also available for you guys. So thank you. If you have comments or questions, leave it here or email me at jscarping@gmail.com. Please subscribe our channel and like our video. Have a very nice day.